shouting, "Let me be absolutely clear about what sanctions are supposed to do." When the United States imposes sanctions, the mechanism is simple. If you want to participate in the global financial system, if you want to use SWIFT, if you want to trade in dollars, if you want access to U.S. markets, you comply, or you're cut off. Pause. For decades, that threat was enough, because being cut off from the dollar system meant being cut off from 60% of global trade. But here's what the architects of that system didn't anticipate. Surprised. What happens when someone builds an alternative system that doesn't touch dollars at all? That's exactly what China has been doing for the last 12 years. In 2013, China launched the Cross-Border Interbank Payment System, CIPS. It's their version of SWIFT. It processes Yuan transactions without ever touching New York banks. In 2018, China opened the Shanghai Petroleum and Natural Gas Exchange. It allows oil to be traded in Yuan, with prices settled in gold, not dollars. And in 2023, China signed bilateral currency swap agreements with 65 countries, meaning trade directly in local currencies, skip the dollar entirely. So when Venezuela needed a buyer for its oil, and the U.S. said, anyone who buys gets sanctioned, China said, we'll take it, and we'll pay you in yuan through CIPS. The sanctions don't apply to us because we're not using your system. That's not defiance. That's irrelevance. The U.S. built a wall. China built a door around it. But here's the part CNN won't explain. This Venezuela-China deal didn't come out of nowhere. It's been under construction since 2019. In 2019, Venezuela signed a preliminary agreement with China to accept yuan for oil exports. At the time, it was seen as desperation. Venezuela was broke and isolated. But look at what happened next. In 2020, Venezuela restructured $20 billion in debt to China. Instead of repaying in dollars, they repaid in oil shipments. Physical barrels delivered to Chinese state refineries. In 2022, Venezuela upgraded the Jose crude oil terminal, the primary export facility on the Caribbean coast. Who funded it? China. $4.5 billion investment. Why? So they'd have the infrastructure to receive 1 million barrels per day when the big deal came. In 2024, PetroChina and Sinopec signed joint venture agreements with PDVSA, Venezuela's state oil company. They didn't buy oil. They bought equity stakes in Venezuelan oil fields. Now they literally own 30% of Venezuela's production capacity. Lower third, 324, 4.5B, Jose Terminal Upgrade, China funded, 2022. And in early 2025, Venezuela opened a yuan account at the Bank of China's Caracas branch. Not for imports, for oil revenue. They were preparing to receive payment in yuan before the deal was even announced. So when the January 3, 2026 deal was signed, it wasn't a new relationship. It was the culmination of 7 years of infrastructure preparation. The United States was so focused on the sanctions regime that they didn't notice China building the bypass. By the time the deal was announced, it was already operational. Now here's what makes this move brilliant from China's perspective. Venezuela has the world's largest proven oil reserves. Larger than Saudi Arabia. Larger than Russia. 303 billion barrels. But because of U.S. sanctions, that oil has been effectively locked away from global markets. Venezuela was producing 3.5 million barrels per day in 2000. By 2020, production had collapsed to 500,000 barrels per day. Not because the oil disappeared. Because they couldn't sell it. China just unlocked it. And they did it at a massive discount. Here's the math. Global oil prices right now are hovering around $80 per barrel. But Venezuela is selling to China at $58 per barrel. That's a 27% discount. Why would Venezuela accept that? Because $58 per barrel is better than $0 per barrel. And because China is the only major buyer willing to ignore U.S. sanctions. Lower third, 528, 1 million barrels, day X, 58, 21.2 B annual revenue. So China gets 1 million barrels per day for 10 years. That's 3.65 billion barrels total, at a 27% discount compared to market prices, paid in yuan, strengthening yuan as a reserve currency. No exposure to U.S. sanctions because they're not using the dollar system. Meanwhile, Venezuela gets $80 billion in revenue over 10 years, economic lifeline without submitting to U.S. demands, proof that sanctions can be bypassed. A powerful ally that doesn't impose political conditions. But here's the uncomfortable part for Washington. This isn't just about Venezuela. It's a blueprint. And within 72 hours of the Venezuela-China deal being announced, 3 other countries took notes. Iran, also under heavy U.S. sanctions, announced it would expand oil for yuan sales to China. They're now shipping 1.5 million barrels per day, all paid in yuan. Russia, facing the most comprehensive sanctions in modern history, redirected 40% of its oil exports to China and India, accepting yuan and rupees instead of dollars or euros. And Cuba, Venezuela's ally, signed a preliminary agreement with China for refined petroleum products, also paid in yuan. This is the coalition of the sanctioned, and they've figured out the cheat code. If you're already cut off from the dollar system, you have nothing left to lose by abandoning it completely. Now, the Biden administration tried to downplay this. The State Department said, Venezuela remains under sanctions, and we will hold accountable anyone who violates them. But here's the problem. How do you sanction China? They're the world's second largest economy. They hold $820 billion in U.S. Treasury debt. They're the largest trading partner of 120 countries. You can't freeze Chinese banks out of SWIFT. Half the global economy would collapse. You can't impose secondary sanctions on countries that trade with China. That would include the EU, Japan, South Korea, and most of Southeast Asia. You can't cut off trade with China. 40% of U.S. imports come from there, and American consumers would revolt when prices spike 30%. Pause 2 seconds. Every enforcement tool in the sanctions playbook assumes the target cares about access to the dollar system. China doesn't. They've built their own system, and now they're offering it to anyone the U.S. has sanctioned. The leverage just evaporated. Now, if you're an American watching gas prices, grocery costs, or energy bills, you need to understand what this means for you. For 50 years, the United States could print dollars to buy oil, because oil could only be bought in dollars. That created automatic global demand for the currency. It kept the dollar strong. It kept inflation low. But when China buys Venezuelan oil in yuan, when Russia sells to India in rupees, when Saudi Arabia accepts dirhams and euros, that demand weakens. And a weaker dollar means oil gets more expensive for Americans, even if global prices stay flat. Imported goods cost more, because the dollar buys less. Inflation becomes structural, not temporary. Interest rates stay high to defend the currency. But here's the deeper issue. The United States has been able to run $2 trillion deficits, fund global military presence, and maintain its standard of living, all because the world needed dollars to buy energy. That era is ending. And there's no policy that reverses it. Because you can't sanction your way back to dollar dominance. Every new sanction just gives more countries a reason to build alternatives. And the most absurd part? The harder the United States tightens sanctions, the faster countries abandon the dollar. Sanction Venezuela? They build yuan infrastructure. Sanction Russia? They develop rupee-ruble trade. Sanction Iran? They join CIPS and sell oil in yuan. Threaten secondary sanctions? You push neutral countries toward alternatives. It's a paradox with no clean solution. Sanctions were designed to isolate economies, but they ended up isolating the dollar. So what happens next? Does the U.S. accept a multipolar currency system and negotiate from a weaker position? Or do they escalate sanctions further, pushing more countries into China's payment system? Can the Federal Reserve maintain dollar strength when oil markets are splitting into dollar zone and yuan zone? What happens when 40% of global oil trade bypasses the dollar entirely? Does Saudi Arabia fully abandon dollar-exclusive oil sales? And if they do, what's left of the petrodollar system? How does the U.S. fund its $35 trillion national debt when global demand for treasuries declines? And most importantly, who controls the energy markets of the 21st century? The country with the most aircraft carriers or the country with the most trading partners? Pause 3 seconds. I can't give you a clean answer because there isn't one. But I can tell you this. Venezuela's deal with China isn't about Venezuela. It's about every sanctioned country realizing they don't need permission from Washington anymore. And that changes everything. This is not a story about Venezuela. This is a story about the architecture of global power shifting in real time. If you want to understand what's coming next, if you want to see these patterns before the mainstream media even knows they exist, you need to follow this channel. Subscribe right now. Because while CNN is talking about arrest warrants and diplomatic scandals, we're analyzing the systems that will define the next decade. Pause 2 seconds. Hit the notification bell. This story is accelerating faster than most economists realize. And if this analysis was valuable, share it. Send it to someone who's asking why gas prices won't drop despite stable global oil markets. Send it to someone who thinks sanctions still work, because the evidence just proved otherwise. The sanctions era is over, and most policymakers have no idea what comes next. Pause 2 seconds. I'll see you in the next one.